What would cause you to sell your gold? I said, that's easy. Easy. I own silver to sell. I own physical silver to sell, and I will sell it at some point in time. First of all, it was oversold. It was too cheap. So the first thing that happened with gold is we got a dead cat bounce. In the period 1982 to 2022, arguably, non-prudent investors didn't need gold. But when people said to me, including on your show a couple of years ago, when's gold going to move? I said, well, I think it's going to move in 2000. In other words, 20 years ago, the price of gold then was 250 bucks an ounce. Now it's
Right.
what, 3,500, 3,400 bucks an ounce. So it's moved
Yeah.
12-fold already. Then people say, well, is it over? Have I missed it? And to them, I would answer that gold really moves when people are concerned about the maintenance of their purchasing power in fiat denominated instruments. And I think that fear is very much alive. That's the most important thing, the interplay between the cost of living increase and interest rates. If you are somebody who believes that the CPI is a good indicator of the deterioration of the purchasing power of your savings, you don't need to buy gold. But the people who construct the CPI don't shop where I shop, and they don't shop for the things that I shop for. And the CPI doesn't include tax. When I look at the basket of goods and services that I buy, and I'm a cranky, old, fat, rich guy. I don't buy much. But the basket of goods and services I buy suggests to me that in the period 2020 to 2025, that the deterioration of the purchasing power of my savings was between 7.5% and 8%.
Mm-hmm.
Look at gasoline. Look at energy. Look at health insurance. Look at health care. Look at groceries. The idea that my purchasing power has declined by 2.5% compounded for 5 years is stupid. It's insane. If you believe, like I believe, that your purchasing power is declining at 7.5% or 8% a year, and you juxtapose that with the interest that you receive on a U.S. 10-year Treasury, the world's benchmark savings instrument, that suggests that you lose 3% of your purchasing power every year for 10 years. There's no more valid reason I can think of to be concerned about the maintenance of my purchasing power than an absolute guarantee that in conventional savings instruments, I'm going to lose 3% a year compounded for 10 years. It means I'm going to be 35% poorer 10 years from now.
In a decade, yeah.
And am I concerned about that? Hell yes. I can do arithmetic. People asked me about 3 weeks ago on my own podcast. They said, Rick, you're a broken record. You're a one-way street. What would cause you to sell your gold? I said, that's easy. Easy. A balanced federal budget, a fiscal plan that accommodates $100 trillion in net present value of unfunded entitlement liabilities. By the way, that number is not from a fat, cranky, bald libertarian, Rick Rule. It's from the Congressional Budget Office. The net present value of unfunded entitlement liabilities in the United States is $100 trillion. So a balanced budget, a fiscal plan that deals with unfunded entitlement liabilities, and positive real interest rates, which is to say an interest yield on the U.S. 10-year Treasury that was greater than the deterioration of the purchasing power of the U.S. dollar. If the real deterioration, by the way, Shadow Stats, John Williams says that inflation is running at 12%. Mm-hmm. That number is not a number I need to prove my point. My point being that until those three criterion are met, that the reasons to own gold is in place. What I see in front of us, Adam, particularly with the unwinding of $100 trillion in entitlement liabilities, is a return to the 70s. I see us honoring the nominal value of our entitlement liabilities by inflating away the net present value.
Yeah.
The Office of Management and Budget calculated that in the decade of the 1970s, the U.S. dollar for U.S. dollar consumers lost 75% of its purchasing power. This isn't my number. This is the government's number. In that same period, the gold price ran 30-fold. Now, admittedly, a third of that was gold catching up, with price controls.
Yeah.
My own belief is that in the next 10 years, the purchasing power of the US dollar will again decline by 75%. My operating assumption is that gold will keep pace with the deterioration of the purchasing power of the US dollar. That would be a fourfold increase over 10 years. Could it be threefold? Sure, I don't know. What I do know is that holding a relatively small proportion of my portfolio in gold and gold stocks, I hedge against a lot of sin elsewhere in my portfolio, particularly in my bond portfolio. A circumstance where the purchasing power of the dollar declines by 75% absolutely massacres a long bond portfolio.
Yeah.
It doesn't hurt it, it obliterates it. It's just arithmetic. It's not narrative.
Right.
We had a period 1982 to 2022 where real and nominal interest rates were coming down. That's over. This is just arithmetic. This is not narrative. Moving on to the boot camp, we've seen a pretty good move in gold. And traditionally, as we discussed earlier in the program, when the precious metals narrative gets established by gold, gold moves first. After a period in time, the higher gold prices means that gold mining companies' cash flow increases as the selling price of their product increases faster than the cost to produce it increases. And that rising cash flow and increasing investor confidence in the gold price means that the gold stocks play catch up. We've just started to see that in the last 14 weeks. Very high quality gold stocks, Silver Wheaton or Wheaton Precious, which we talked about on your show a year ago, Agnico Eagle, which we talked about on your show a year ago. Those companies are up 50 or 60%. Investors are asking if that's over. If past is prologue, if you look back to the period of the 1970s, the early part of the 1990s, or the period 2000 to 2006, the answer to that is clearly no. In a gold bull market, the best of the best rise 250 or 300% peak to trough. Then, as the narrative begins to be proven in the best of the gold mining companies, valuation arbitrage, begins to pull generalist investors' money into the rest of the gold mining industry. And ultimately, anticipating your question, the last mover in precious metals is silver. When the generalist investor comes down into the precious metal space, attracted by price momentum, perhaps because of the lower unit cost, or perhaps because of its reputation for volatility, upside volatility, or perhaps both, silver moves last. But it moves furthest and it moves the fastest when it moves. So I would ask your listeners to refresh their memory with regards to history. Look at prior gold bull markets as to why they occurred, and ask themselves whether the circumstances that they see augurs well for a new precious metals market. If the answer is yes, think about how bullion might perform in their portfolio as a hedge against other asset classes. Think about how the best gold stocks, the subject of our upcoming boot camp, perform in a gold bull market and whether or not those are appropriate. Think then, because our third boot camp will be speculative gold stocks, about what happens when market leadership changes to them. And then finally study history and think about the most volatile of all precious metals asset classes, which is silver and high quality silver stocks. And the truth is, people, you will not need Rick Rule on your program to define when silver moves. Those moves are dramatic. I'll get rid of mine. I bought silver to sell it.
Okay.
I bought gold to insure my portfolio and to be a form of liquidity, albeit volatile liquidity. For people who have a trading mindset, there are some people who bought gold at $2,000 because they thought it would go through $3,000. Okay, they did it. Sell it. If you're a trader, by all means, if you bought it for a trade, you recognize your goal. Sell it. You have a, what, 40% move in 2 years? Look at other asset classes and think about where you did that. Other than cryptos, probably nowhere. So if you're a trader, sell it. I own silver to sell. I own physical silver to sell, and I will sell it at some point in time. I don't know where now. And I own a pretty good sized basket of silver stocks because my experience in past bull markets is that the gain that you get from decent quality but small silver stocks really defies description. They feel like the uranium penny dreadfuls. I don't have those with any expectation that they'll be sold by my estate. In other words, they won't survive me. I will sell them. My suspicion is that I'll sell that basket for 10 times or more what I paid for it. That type of return carries with it the promise of substantial volatility and substantial risk, which I recognize. For my gold, I would suspect that the balance of my gold, the balance of gold in my own portfolio, physical gold, will be sold by my estate.